Hello, Craig from Wealth Minus Wall Street. Today we want to talk about our business owner money multiplier program. And we want to explain to business owners how they can leverage unnecessary taxes and unnecessary investment and business expenses into guaranteed assets that can either be reinvested in their business or personal savings and retirement. So here's the small business owner problem. You're wearing multiple hats, you're covering a lot of departments, you're pulled in many directions. So you're really at the mercy of trusting expert advice and potentially without the ability to properly vet. And when we're talking about this, we're talking about the most common experts that you talk to about the finances of your business, and that could be a CPA financial advisor. So we think we have a solution to the issue that you face, and we're going to walk through what these problems are. But we're going to show you how you can take tax overpayments, unnecessary investment fees, unnecessary business expenses that maybe you aren't aware that these things were causing a problem, not only for your business, but also for your personal and retirement. We're going to show you how to take these savings and bridge that savings into assets, either for the business or for your personal and retirement. So this is that whole concept of money multiplication, right? We're taking something that you're already spending, but now we're just repurposing it into something that's going to grow for you. And we'll walk you through the numbers, and that growth can be very, very significant. So here's the danger of following the status quo. You deal with your typical CPA. We found that many small businesses are leaving $10,000 or more on the table because their CPAs aren't focusing on 3 or 4 core strategies that we see day in and day out that they don't have you take advantage of. Financial advisors. We see constantly business owners have no idea how damaging investment fees are over their lifetime. This can be $100,000 or more. And the problem is some people will say, well, you got to pay for something, but you should be getting something for that payment. And there's no guarantee that you're actually better off for paying these fees is a problem. And then business expenses. We'll walk through at the end of this presentation some areas that we have partners that can help you identify and vet some of your vendors. What we see is on average, businesses are paying about 20% more than they should. So what we're trying to do is reduce these costs, take these savings, and create wealth for your business or yourself. So let's touch on CPAs first. So here's the issue that you might not be aware with when you deal with CPAs. First of all, most people are employees, not business owners, right? So that means most clients, unless your CPA only deals with business owners, most of their clients are going to be employees and not business owners, right? That's a problem right off the bat. CPAs actually also don't think like business owners. So that comes into play when they're thinking about proactively ways to put together tax planning strategies and things like that. If they're not thinking like a business owner, that's why they miss a lot of these core strategies. They specialize in tax preparation, sometimes called compliance work, and not tax planning. That's a huge difference. What most CPAs do is, I always say, they're trying to keep you out of jail, right? They want to get your taxes paid on time so the IRS doesn't come knocking at your door. They're not planning, which means you are overpaying most likely because you don't have proactive tax planning going on. And when I do talk to CPAs, a lot of times when we talk about tax planning, they think tax planning is just maxing out or deferring income in a retirement account. That is not tax planning at all. And we're actually going to show you in a little bit that for some of you, it could be very short-sighted, kind of penny wise and dollar dumb. That's not tax planning. You know, if your CPA just says, oh, you paid all this money, let's take 60 grand and put it in a SEP or something like that, that's not planning. At the end of the day, it could be the right thing to do, but that's not what we consider tax planning. So here's the options we created that will put you in a better position to succeed. So we've created a small network of small business CPAs that specialize in small businesses and tax attorneys. Right? This is what the wealthy do. Everybody talks about why do the wealthy and these big corporations pay less in taxes than we do? It's just because they identify specialists who understand the tax code and use it to the best of their ability, right? Most CPAs aren't doing that for you. We mentioned there's really 3 or 4 basic strategies we see that we think business owners can take advantage of that they're not. These are pretty basic as well. So we can run an audit and take a look at what you're doing. We can make sure you're taking advantage of these strategies. We want to show you all the tax implications of saving for retirement, right? That's the key we just touched on. Deferring income isn't a strategy. Potentially, depending on the type of retirement plans, we'll get in this in a second, it might be adversely affecting your retirement savings, right? So we want to make sure you understand taxes and the other ways you can save. And putting money in Wall Street retirement plans for a business owner, there's other tax advantage strategies that might be better and actually be more aligned with what you would like to do in terms of building your wealth. And that goes into the last point. All assets aren't equal when it comes to tax efficiency. Some assets are more tax advantaged to others, and we'll touch on them in a minute. So here's kind of the multiplier effect. So let's say, hypothetically, we were able to figure out that you're overpaying your federal taxes by $12,000 a year, right? So that's $1,000 a month. Well, here's the growth rate of getting 8, 10, and 12% return, right? So you take that 12,000, you don't just sit it and put it under your mattress, you invest it. Now, here's the difference why, again, we're different than your CPAs, financial advisors. They're going to tell you invest in the market and put it in a retirement plan, all that stuff. Well, what if you know your business better than any person helping you? What if you bought a piece of software that could increase your returns 12%, 14%, 20%, right? That's where we want to make sure you understand where the advantages are. But just in this example, we just wanted to show you how powerful compounding is over 10, 20, and 30 years at $12,000 a year. So if you look, depending on your age, this is really going to see where you fall. But even at 10 years, we're talking about 6 figures. At 20 years, we're $500,000 and up. And at 30 years, you've become a millionaire or a multimillionaire. If you're 30 years old and you're overpaying your taxes 40 years old, you can get to these numbers. This is life-changing wealth that we're talking about. So now let's touch on the next piece of the puzzle, where a lot of folks, as they start to build wealth, will seek out financial advisors and get their help. So here's the problem that you're probably not aware with financial advisors. Same thing as the CPAs. Most of their clients are employees, not business owners. Unless your advisor specializes in business owners only, business owners think differently than from employees. It's a different mindset. And most of the strategies that financial advisors recommend fits really nicely for employees, not necessarily for business owners. They focus only on investments they sell. So there's many ways you can build wealth, not according to a financial advisor, right? They're only going to talk about what they can sell. So it forces and funnels all of your assets into the Wall Street umbrella. We're going to talk in a minute about how damaging those fees can be over your lifetime. Because of they're trying at the end of the day to sell you a product or service, they put their self-interest ahead of your best interest. There's a lot of reasons for that. We have other videos we can share with you, but they make so much money based on the fee structure that because this money's there, it affects their recommendations from a planning standpoint, from strategy standpoint, things that you're probably not aware of, but it's a reason why the deck is stacked to get you a Wall Street if you understand how the game works. And this leads to the last point. Their advice most likely will negatively impact your net worth, and it's because the fees are so high. There's a couple quick videos on our website, Wealth Minus Wall Street, from Warren Buffett and his co-manager at Berkshire, Charlie Munger. And they talk about this. You don't really need an advisor. What advisors, quote unquote, sell is superior performance, and that does not exist. Statistically, it doesn't work. The point is that Warren makes, and we believe it here at Wealth Minus Wall Street, if you just make investing a purchase decision and you buy an investment a lot more inexpensively than an advisor can, you cut out their middleman fee, you're going to do better, right? It's a lot of times it's the same investment. So there's a likelihood that you're most likely negatively impacted by this fee structure, that most of you are probably unaware of this. So here's what we've created. We want you to understand what goes into traditional retirement planning. Okay. What we mean by that is the traditional retirement plans are geared more towards employees and business owners. It leads to assets, not income, right? You're taking a risk every day being a business owner. We think for you, your investment strategy should be much different and should create some certainty, things that employees don't have because they have more certainty with their paychecks, benefits, those types of things. We're going to help you understand how Wall Street is rigged, and it absolutely is. We'll make sure you understand how fees impact you, how investment strategy impacts you, and how all this works, and actually show you how this negatively impacts you. Put a customized plan in place that's aligned with your interest and goals, right? So there's the old saying that if you're a hammer, everything's a nail, right? And that's what financial advisors are. When they say they do planning, they're not doing planning. They're basically coming in and saying, okay, here's their planning. You're this age. Here's how we want to allocate your money, and let's just start the clock ticking on you paying the advisors, right? Well, what if you want to build your wealth by investing in real estate? What if you want to buy another business, right? Whatever you want to do, you can. Advisors don't want to hear it because they want you focused on what they can sell you. And then evaluate all retirement savings options available to you. The cookie cutter saving for retirement, it's got to be in a retirement plan. It can. There's pros and cons with that. You only hear the pros, not the cons. We want to make sure that you have all of the options that fit what you want to do to grow your wealth instead of Wall Street telling you what you need to do with your own money. So here's the playbook, and some of you might be at one of these stages, and so maybe you've experienced all three, but you kind of start your business, you start making some money, you have somebody do your taxes. What does the CPA say? Remember, the CPA is not trying to provide long-term value. They're just trying to justify their returns for that year. So you're starting to make money like clockwork. They're going to say, okay, you need to open up a retirement account and start contributing so you can defer some. Again, on paper sounds good. We'll explain why that might not necessarily be the case. Now your business is growing. Now the CPA says you probably want to max out your retirement plan, your contributions if you weren't already. And then maybe somebody tells you you're building more wealth. You probably should hire a financial advisor. Now your business is growing faster. You're with that advisor, and they're telling you, "Hey, you want to diversify? Get some wealth out of this business. All your eggs are in that one proverbial basket, and we'll help you diversify." So that may or may not be good advice either. Look, they can probably make a pretty compelling case, but again, you have to understand what's kind of going on behind the scenes. So let's address some of these problems real quickly. So the CPA recommends contributing to a retirement account. Do they know the fees that you're paying? They do not. Do they know what investment options are available to you? So let's say if you have a 401k with a certain provider, they'll give you a menu. They have no idea if those options are good or not. Are they letting you know that you're essentially locking up your money until you're 59 and a half, making it pretty restrictive to get out, again, without knowing the fees or the investment options? And are they explaining to you the tax consequences? This is tax deferral, not tax free. So what we see time and time again, you might see some friends doing it, family, or maybe you've done it. We're talking about these IRA conversions now, right? IRA conversions into Roths, because people are saying, I don't want to pay all this money in taxes when I retire, because when is $1 million not $1 million? When it's in a retirement plan, right? And we think this is silly because if any of you are doing a Roth conversion, most likely you've gotten bad advice, because that means either your advisor or your CPA never sat down and said, wait a minute, hey, I know the tax deferral feels good, but let's look bigger picture and decide if this makes sense for us. Now we get into the max out the retirement plan, hire an advisor. right? Sort of the same issues that we still have. Well, are you aware of the fee structure? The whole concept of diversification. So most retirement plans, they come along with a diversified portfolio. If you're looking to grow your wealth, it equates to a money prison. You're just locking your money up and it's not going to grow fast as it could in some other vehicles. Now your business is really successful. You're starting to really create some assets, some wealth. Your advisor says, we should diversify out. Let's move a little bit out and diversify you. On paper, diversification makes a lot of sense, but it goes back to, are you aware of the fees that you're now going to be paying this advisor? Can you properly evaluate, are those fees worth it? And what's your strategy going to be? It's going to go back to only what Wall Street sells. So that's just one small piece of the puzzle on how you can grow your wealth. So bottom line is, all of these things maybe on paper and up until listening to this, maybe you all thought made sense, but you really need to understand that a lot of this may or may not be in your best interest. And our job is just to make sure you understand the pros and cons of every decision that you're going to make. So let's talk about the fees. I think that's probably sometimes the hardest to grasp when we go through this, is understanding. People don't realize how, because fees are so hidden and they're hidden on purpose by advisors in Wall Street, because they don't want you thinking about it. These fees are, it's insane how much money you pay over your lifetime. So let me just give you a quick example of just an average person saving for retirement. So let's say once they start getting their business going, they save $10,000 a year for 20 years. Then they contribute $20,000 a year in years 21 to 30. We will say an 8% growth rate. And the annual fee for some sort of retirement plan is 0.75%. That's going to be low for a lot of small business owners. That number probably is well north of 1, but let's just say 0.75. Then let's just assume that after that 30 years, you retire and now you go out and hire an advisor. You're going to withdraw $50,000 a year, and we're going to index that for inflation. And then we're going to put the annual fee at 2%. So remember, when you hire an advisor, there's two fees. There's what you pay the advisor and then what you pay the money manager. Typically, an advisor will charge about 1%. Could be a little bit less. Usually it's not. It could be a little bit more. Usually it is. And the investments. So the investments, we just say as average. So if you're in more of the passive investments, it's going to be a lot less. But our point is, if you're in passive investments, you need to realize that's proving you should not be working with an advisor, because he's adding no value if you're just buying passive investments, or they could be a little bit more depending on the investment. So on average, about 2%. So let's just see what happens here. So here's the total lifetime fees paid. So over $500,000 in that example, over, I believe it's about 57 years, 30 years growth and 27 years in retirement. That's when we stop the projection. So 57 years, over $500,000 has been sucked out of your net worth. Versus if you just went and bought one of these passive investments, the fee would be $41,000, right? Huge, huge difference. So let's look at this graphically. So 0.07% fee versus that 2% fee, contributing the same growth, net gross growth rates are exactly the same. And what you see, obviously, is your money grows a little bit faster with the lower fee. But what you really see the big divergence is when you bring in that advisor fee. And that's really our point. In this example, that $77,000 is in year 77. So the next year you're bankrupt. You have no money left. And versus 1.9 million in the 0.07%, right? So that's how impactful the fee is. I mean, it's a difference of $1.9 million. It's game changer. This is money for your family, kids, grandkids. This is life-changing wealth. And it's just by removing a fee that maybe you're better off. Again, it's really hard for them statistically to prove it, but your fees are guaranteed. As you know, you pay a fee whether you make money or lose money. One of the biggest risks you have in retirement is actually working with a financial advisor, because this is the impact they can have on your net worth. So here's some of those issues with that 1.9 million. So you have 1.9 million, which is fantastic, but there's no guarantee that your account will achieve that growth, right? So that's one of the big misnomers when it comes to retirement planning. You don't have a plan, you have a projection. You have hope. You're crossing your fingers. Because as we talked about, all financial plans or most financial plans are based on asset growth, not income, not guaranteed income and not generating income. It's your asset growth. Well, what if your assets don't grow, right? And we don't have to go too far back to understand what happened in the 2000s. The market was flat for a decade, right? We had two crashes, 2002, 08, 09. So, what would have happened if you were retiring in that window? That would significantly impact the ability for your wealth to grow to 1.9 million. So again, it's a hope, it's a projection. We don't consider that a plan. In the example we gave, that money too is going to be all fully taxable to you and your heirs. So it's that 1.9 million isn't yours. You have a retirement partner, and his name's Uncle Sam, right? So they want their cut. And oh, by the way, they changed the stretch IRA provision, which made it more, you can't stretch over lifetimes anymore. They cap it at 10 years. So that's something else that you want to think about in terms of the long-term, legacy planning benefits of IRA accounts. Because interest rates are so low, they're going up now here, but they're still historically low. You used to hear this 4% rule, Morningstar and a lot of these companies that did long-term projections and looked at various distribution models. They said that you could feel pretty good if you were distributing 4% of your income. So easy math, you have $1 million, you take out 4%, that's 40 grand. They run the illustrations. That money's probably going to last 30, 35 years. You have a really good chance to do it. Well, because rates are so low, and now a big piece of the allocation that makes up this illustration is bonds, they're basically saying now you got to take out 2.8%. So for every $1 million, you can only take $28,000 out. No, by the way, that's fully taxable. That's not a great return. So, none of that income is guaranteed. So in this model, you've saved only one way, which is asset growth. So you have no guaranteed income. You have no guarantees against principal protection, right? So there's no guarantee in place. And advisors want to say you're diversified, but you're not. You're diversified in what they sell. We have other videos on this, but just so you understand, diversification, traditional asset allocation, maybe it changes, but what we've seen, especially in market periods of market volatility, assets go lockstep with each other, right? In the good old days, bonds were bad, stocks were good, vice versa. US stocks weren't doing good, Europe or Asia were doing good. Because we're such a global economy, and really the central banks around the world have really manipulated the markets with their monetary policy. Diversification, Wall Street diversification, you probably could make the case it's not going to be as impactful as it used to be when we weren't such a global, manipulated, coordinated global market. So when we talk about our solution for your retirement multiplier, here are some of the things that we think you should be bringing into the fold. You want assets that are tax efficient, okay? You want assets that come with guarantees. You want assets that are fully accessible whenever you need it. And you want assets that match your goals. So what does that mean? Well, it basically means when we talk about diversification, a part of your assets in Wall Street probably makes sense. But there's other pieces that most business owners aren't taking advantage of that are phenomenal tools for you to build wealth. Okay, one is real estate. Real estate might be the most tax advantage asset out there. You get huge deductions if you know what you're doing in depreciating the property, which can actually, if you do it the right way, could potentially offset business income, or at a minimum, it can create tax-free income for a while because you get this huge deduction. Right, the gains are tax deferred. You do 1031 exchanges so you can keep deferring debt taxes. And if you compare it to a retirement plan, as that money grows and it comes out, it's taxed to capital gains on income, which for most business owners, usually capital gains will be lower than ordinary income. The other thing is insurance, right? So insurance gets a really bad name, and you got to be careful, just like any investment. So the issue with insurance is you need to understand that the insurance agents, they can kind of adjust their commission based on your death benefit. So for a lot of business owners that we talk, we recommend taking, unless you really want the death benefit, but we're talking more about a utilization for during your lifetime, but also having something for your kids and grandkids should something happen to you. But if you take a look at more of a reduced benefit where you're maximizing cash value, it's a really effective tool because that gives you instant access. The cash is yours. If you do it right, you can take that money out tax free when you start taking distributions. Or if you have it, if you want to buy a piece of real estate or you want to buy a piece of equipment or a piece of software for your business, it's not locked up to 59 and a half. So it's a really good tool to evaluate. Like everything, there's pros and cons, but typically what we see of financial advisors, because they want to maximize assets, so they might talk you out of insurance. Financial advisors definitely don't want you buying real estate. So again, you have an issue of, okay, what's really best for you? And that's really our role, is to try to make sure you're putting a plan together that really matches how you want to grow wealth, but also doing it as efficiently as possible. And a lot of times that really means managing your taxes. Last point here, we talked about the kind of the third piece of the puzzle is the reduced business expenses. So we've identified partners that can come in and take a look at your telecom bill, your waste management, your merchant services, digital marketing and advertising, small package shipping and courier and utilities. Take a look at for free and give you an idea of if there's the potential there for cost savings. So all this is done totally free of charge and give you an idea, hey, you might be paying a little bit more, and then they can negotiate better terms with your vendor. So as we had mentioned earlier, the average savings is about 28%. So that's something that we think is really important too, and a lot of times overlooked. And it's definitely overlooked if you're applying for CPAs and financial advisors. They don't touch this stuff. They're most likely not bringing up to you, but we think it's unbelievably important to make sure you're paying what you should be paying and not a penny more. So if you'd like to have a quick conversation, we can go into more detail about our business owner money multiplier, go into detail about how it works, how potentially we can save you a lot of money on taxes, investment fees, and business expenses, and strategies to leverage that money into really growing your wealth in a way that you're not doing right now. We'd be happy to have a conversation. Here is all my contact information and look forward to chatting with you. Have a great day.